January 15th, we'll have Wells Fargo and JP Morgan kicking off the earnings season. The bank stocks between now and then, we'll see how they act. But I think into earnings season, we have some cautious. We're a bit cautious on the banks. We do believe 2019 will be a challenging year for the banks. We think right now earnings estimates, not necessarily for the fourth quarter, but for 2019 and especially 2020 are a bit too high. And as we get through earnings season and us analysts start revisiting our models, you could see some pressure on earnings, and it may not make the banks overall look as inexpensive as they may look today.
Interesting. Which area of earnings in particular? Across all of their sort of subsectors, or is there a retail focus, investment bank focus?
Yep. So looking at their net interest margins, most investors I talk to, it's the first thing they're looking at when banks report earnings. And the money they make on their assets, loans, securities over their deposits is going to be under pressure. Think back a couple of months ago, we were expecting 3 to 4 rate hikes, or at least the market was expecting 3 to 4 rate hikes in 2019. The 10-year earlier this quarter was at 320 plus, and now we're down to 275, 280, maybe one rate hike next year. So that's going to pressure bank asset yields at a time when their cost of deposits is rising pretty substantially. So that deposit beta is putting a lot of pressure on that net interest margin.
So basically, the outlook, the consensus outlook for NIMs aren't where they should be, given the change in the outlook for interest rates that have happened in the past month or two.
Absolutely. If you look at most of the consensus estimates, there's been very little change since October. And like I said, 10-year was much higher. Expectations for rate hikes were much higher. And deposit betas typically lag. And we've seen overall deposit betas at about 35% cycle to date. And that number typically gets closer to 50%. So we expect those deposit costs to rise faster, which will put pressure on that net interest margin. And like I said, I don't think all that is built into expectations right now.
But David, in terms of the valuation, traditionally banks trade at about 75% of the S&P 500 average P. They're trading at about 60% of the S&P 500 average P at the moment. So you're painting, if you don't think that's priced in, you're expecting quite a sort of recession-type performance in earnings over the next year or two.
I don't know if I'd call it a recession type of earnings outlook, but definitely versus expectations right now, that is too high. And that multiple that we're looking at, that forward PE number, is probably a bit low, given that the earnings number may be overstated right now.
If you had to pick one to buy, which one would it be?
Right now, the name that I like is Zions Bancorp out of Utah. They're a West Coast-focused bank. Great deposit base, reasonable loan growth. They have excess capital, and they're buying back their stock. And they do have a revamped credit culture over the last 5 to 6 years I don't think is fully appreciated.
Of the biggest names, which is the main one to avoid?
Wells Fargo. Wells Fargo is one. It does look inexpensive, but it still trades at a premium to a lot of its peers. They've got fundamental problems. They're not growing revenue. I expect the revenue to be down again in 2019, down in 2020. And look, their earnings per share at about $1 per share right now has not changed over the last 5 to 6 years. And from a profitability perspective, their return on tangible common equity, which was better than peers 5, 6 years ago, continues to lag its peers by a couple percentage points.